Imagine standing beside a giant lake. On one side, someone is pumping water in. On the other, someone else is quietly draining it out. At first glance, it looks absurd. Why would anyone pour water into a lake only to suck it out again? Yet that's exactly what the global financial system does every single day. The central banks of the world, the Fed, the European Central Bank, the Bank of Japan, are all playing this strange game. They lower interest rates and pump cheap money into the system. At the same time, they shrink their balance sheets, draining that same money back out. It's theater on one side and real power on the other. The public sees the performance rates down, relief ahead, recovery in sight, but behind the curtain, the quiet extraction continues. And if the outflow ever outruns the inflow, the lake runs dry. That's when economies choke, liquidity freezes, and panic spreads. Money isn't just paper, it's a temperature gauge of trust. When interest rates rise to 5%, money becomes expensive. People hold back, investments pause, circulation slows. When rates fall, money cheapens. Everyone borrows, spends, and chases returns. That's the visible story. But the invisible one lies in what the Fed does with its balance sheet, whether it's truly printing money or just pretending to while it quietly destroys the old supply. A bank works the same way on a smaller scale. You deposit $100. They lend it to someone else, buy bonds, or invest in mortgages. Your money multiplies on paper, but only because everyone agrees not to withdraw at the same time. When they do, the illusion breaks. The Fed is the banker's banker. It can print the money that saves the banks or refuse to, and watch them drown. Over the past few years, the Fed has done something subtle. It's been shrinking its balance sheet while lowering rates. That means it's whispering comfort while quietly pulling oxygen from the room. In 2022, the Fed held more than $8 trillion in assets, treasury bonds, and mortgage-backed securities. By 2025, that number had dropped by trillions. So while the headlines screamed rate cuts are coming, the real story was the opposite. Less money in circulation, tighter credit, more fragility. It's like a fireman spraying a burning house with one hand and stealing water from the hose with the other. Most people don't notice this contradiction because they're focused on the promise of cheap money. But the Fed's goal isn't to make you richer, it's to manage risk for the entire system. And sometimes that means pretending to give while actually taking away. When money gets expensive, everyone feels it differently. Businesses stop hiring. Governments struggle to pay interest on their debts. And investors, well, they start looking for safe places to hide. That's when gold starts to shine again. You might have noticed, even as rates fall, gold keeps climbing. That shouldn't happen in theory. But theory never had to pay rent or survive a financial storm. Why does gold rise when the world is printing money? Because people no longer believe the money is real. They see the same lake we just talked about, full on the surface, draining underneath. The truth is, every major central bank is playing this double game. The US drains dollars, Europe drains euros, Japan drains yen. And when all three close their taps, liquidity disappears worldwide. Countries that rely on dollar reserves, the exporters, the indebted, the fragile, are the first to suffocate. Their currencies fall, their debts rise, and the cycle repeats. That's how the global order maintains itself, by controlling who gets to breathe when liquidity runs thin. In the late 1990s, Southeast Asia learned that lesson the hard way. When dollars vanished, local currencies collapsed overnight. Property empires, companies, savings, all gone. And who showed up to buy their assets for pennies? The same players who drained the water in the first place. It's not a conspiracy. It's just how power behaves when disguised as policy. So when you hear that the Fed is cutting rates to fight unemployment, pause for a moment. Ask yourself, what's happening to their balance sheet at the same time? Are they printing more dollars or burning them quietly? The market reacts to words, but wealth belongs to those who watch actions. The same principle applies in your own finances. Most people think they're saving when they're really standing still. They earn, they spend, they stash some in the bank, but the bank is playing its own version of the same game, inflating, draining, recycling. You can't outsave a system built on engineered scarcity, but you can learn to surf its tides. That begins with understanding money not as a possession, but as a moving current. When it flows too freely, it loses value. When it freezes, opportunity disappears. The goal isn't to stop the current, it's to position yourself where it naturally pools. That's why the rich seem calm when the market panics. They don't chase the water, they build dams. You can do the same on a smaller scale, by owning productive assets instead of consumable ones. By holding a mix of cash and scarcity, things that hold value when confidence evaporates. And by remembering that every boom and bust, every emergency and recovery is just the sound of someone adjusting the flow behind the curtain. The system was never designed to make everyone wealthy. It was designed to stay balanced, even if that means tilting the scale against you. But when you understand that, you stop playing blind. Let's zoom out. When the Fed, the European Central Bank, and the Bank of Japan all shrink their balance sheets at the same time, the world's oxygen supply, dollars, euros, yen, starts to vanish. And because roughly 90% of the world's reserves are held in these three currencies, the rest of the planet is gasping for air. It's easy to think this is an American story, but it isn't. It's a global domino effect. A factory in Vietnam that exports to the US earns dollars. A shipping company in Greece settles contracts in euros. A power plant in India buys oil priced in yen and dollars. When the supply of those currencies contracts, these businesses can't pay debts or restock materials. The weakest economies go first, not because they mismanaged money, but because the oxygen was pulled from their room. Step 1, create scarcity. Step 2, let crisis strike. Step 3, arrive with a lifeline in the same currency that disappeared. It's the same cycle, century after century. Liquidity droughts followed by rescue packages that come with ownership strings attached. That's how global empires are maintained without firing a single shot. And here's the twist. Scarcity isn't just a policy choice. It's a strategy. Scarcity makes assets cheap. Cheap assets attract powerful buyers. And power, once consolidated, doesn't spread itself around again easily. You've seen this movie before. In 1997, when the Thai baht collapsed. In 2008, when American banks swallowed global finance whole. And you'll see it again, because scarcity cycles are the heartbeat of capitalism. So where does that leave you, the individual standing on the shore, watching the lake drain? It means you can't stop the tide, but you can decide which boat to be in. When currencies become volatile, the smart money moves to things that don't need a printing press. Gold, land, productive businesses, intellectual property, not because they're glamorous, but because they're immune to someone else's interest rate decision. Over the past century, gold has served as humanity's I don't trust you asset. When trust in governments, banks, or paper money erodes, people go back to the oldest agreement we ever made. This shiny metal has value because everyone says so, and no one can fake it easily. That's why central banks themselves, the same institutions that issue the money, are buying gold at the fastest pace since They understand the paradox better than anyone. In a world where everything is a promise, sometimes you need something that isn't. And gold today isn't what it used to be. The ultra-rich don't just hoard bars and vaults. They lease them to jewelry firms, earning 3 or 4% a year in rent. They use gold as collateral to borrow cheap dollars from Swiss banks, reinvesting the proceeds elsewhere. In a way, they've turned the oldest store of value into a modern income stream. It's an irony the system itself might appreciate. You see, even as the Fed drains dollars, investors are quietly converting those same dollars into real assets that can't be quantitatively tightened. That's how wealth survives policy shifts, by stepping outside the rules of the game. But you don't need billions to play smarter. You only need awareness. Awareness that low interest rates don't always mean easy money. That stimulus can be smoke while liquidity silently vanishes. That when everyone's celebrating cheaper loans, the real players are watching who's quietly selling bonds. An awareness that every time trust in paper wobbles, the world remembers gold, or its modern cousins, scarce digital assets, farmland, water rights, patents, or simply productive companies that make things people actually need. Wealth doesn't vanish in crises, it just changes hands. It flows from those who react to those who prepare. So when the next rescue plan appears on the news, look past the headline. Ask who's gaining control of what. Because behind every bailout, every rate cut, every promise of relief, there's a balance sheet quietly rearranging the map of power. And on that map, the safest place isn't where everyone's running. It's where trust still holds value and scarcity still works in your favor. Hold assets that don't need permission. Learn to read between policies, not just headlines. Understand that when the world's water level drops, those who own the wells aren't panicking. They're waiting. That's the mindset of resilience. It's not fear, it's clarity. It's what separates those who drown in each cycle from those who quietly build empires beneath the surface. Stay calm when others chase panic. stay liquid when others freeze. And when the world forgets that balance sheets shape destiny, remember this lake, filling and draining again and again, because understanding the game doesn't make it fair. It just keeps you from being the one holding an empty bucket. Every crisis hides a pattern. Every pattern hides a choice. And the choice is always the same. Stay afraid or stay aware. If this video helped you see the game a little clearer, don't keep that clarity to yourself. Share it with someone you care about, a friend who saves but doesn't yet invest, a parent who still trusts the headlines, or anyone who deserves to breathe easier in the next storm. Hit that like button if you learned something new today. Subscribe to The Passive Path so you don't miss the next step toward financial calm. And drop a comment, tell me what part of today's story surprised you most. Your thoughts help shape the next videos we make. I hope the week ahead treats you kindly, your mind stays steady, and your money keeps working while you rest. If you'd like to keep learning, there are more videos waiting right here, each one built to help you see money, risk, and freedom with clearer eyes. Thanks for watching The Passive Path. Take care, stay patient, and I'll see you in the next video.